Good afternoon and welcome to the AICPA Town Hall Series. We've been conducting these for the past 3 months. Actually, this is the 15th Thursday in a row. We really appreciate being with you. We always learn a lot. I'm Eric Auskerson, one of your hosts for today. So let me kick this off and just cover some housekeeping items before we introduce the other presenters. So we're using this modern platform. I think most of you are familiar with it. To earn CPE, just click the boxes that show up throughout the presentation, and also at the bottom there's a toolbar there that has a lot of different capabilities. It enables you to print out your CPE certificate at the end, but if you don't do that, you will receive an email with information on how to get your CPE certificate, and you also can ask questions and download the materials that we've made available for today. And we've got a lot of materials that we're going to be discussing shortly. So let me now introduce the different presenters. First off, I'm Eric Auskerson, President and CEO of CPA.com, the business and technology arm of the AICPA. With me is Mark Koziel, who you all know very well and has been here every week. Mark leads the firm services section for the AICPA. We also are fortunate this week to have Ron Baker, clearly one of the leading thought leaders for the profession, someone who's provided so much advice and guidance over the years, and he's going to help reflect with us on what a defining time this is for firms, and he's going to give you his thoughts related to firm strategies, pricing strategies, and to just talk more broadly about some of the other business relief items that we have going on right now. We also have with us Chris Esposito, one of the leading tax experts at the AICPA, and she's going to talk about the employee retention credit, the ERC credit. We want to dig a little bit deeper into that this week. And then we have Lisa Simpson, whose team has been putting together all of these resources over the past many weeks and has done just a terrific job reviewing the latest guidance every week. So here's what we're going to cover today. We're going to do a brief recap of some of the town halls. We're going to share with you some of the top FAQs. So before you start asking your questions, let us get through that section. Then we're going to talk broadly about what's going on. Then we're going to have that discussion with Ron Baker, do a little bit of a deep dive into the ERC, and then have our weekly open forum. So Lisa, this highlights what we've covered over the past month. I mean, it really has been all about the loan forgiveness process. Anything particular you want to highlight here?
Thanks, Eric. I just want to let everyone know that if you weren't able to join us our previous week when we were reviewing loan forgiveness, we've put together some of the slides from the last couple of weeks into a package that you'll find in the resources you have available as a download in today's materials. So don't worry, you're not going to miss out on all the loan forgiveness stuff. It's there for you to review. And if you need the audio to go with that, you can click on one of the links for the town halls that you see there. We also have the FAQs in your resource materials that Eric is showing on the slide now. So we listed out some of your top questions that we've been getting and mapped you out to the AICPA's FAQ or to an additional resource that is available for you. The FAQs are in your downloads, in your materials. If for some reason you can't access them through the webcast materials section, then you'll find a link at aicpa.org/SBA. Thanks, Eric.
A lot of valuable information there, and your questions have helped us put those lists together. So here's the questions, Lisa, that we're still working on with Treasury and others.
We are still waiting for this list to get whittled down. So if you are asking about retirement plan costs, then we still don't have an answer definitively for you on that, but we're continuing to ask. So we hope that'll be covered in an FAQ. We're also getting lots of questions about applying early and how to use some of the FTE reduction calculations within that process. We do not have good examples on that yet, so we just want to continue to wait and see what we can get from that one. So again, top questions that we're still looking for some guidance on. There are plenty of others, but these are just some of the ones that we get asked frequently through these town halls. So just keep waiting, hopefully be patient, and we'll get our answers soon.
And we'll be talking about that in a minute. The answers will be coming. The FAQs have not come out yet, but they will be coming out over the coming days. So let's just step back for a moment and just talk about where we're at. We've been, in April we were reflecting on the process. Now we're really looking forward. We've been talking about how these past 100 days, 10 years of relationship building has occurred. But as we continue to think about the second half of 2020, the next 100 days or the next 6 months, we're beginning to realize that this time will probably be even more important. I mean, there's lots of businesses that are under tremendous stress. Last week with Gene Marks, we talked about a lot of the different things that advisors should be discussing with their clients right now that are having some real financial issues. We also discussed how disruption brings opportunity, and we're beginning to see that more and more, that there's going to be a lot of new business starts. There's going to be a lot of businesses that are taking advantage of some opportunities, buying up inventory, doing M&A. There's going to be additional business relief coming and changes to the tax code that's going to encourage some of this business creation activity. So this next 6 months is going to be a time like none other for the profession and trusted advisors to really continue to work with their clients. And we're going to be talking to Ron Baker about his thoughts on that later as well. When you look at where we're at in this recovery, one word you can use, I'm a sailor, and you can use the word choppy. It's going to be very choppy. The seas are going to be confused, and it's becoming more clear that it's going to be this is a McKinsey slide, and it shows projections for a recovery with a virus reoccurrence and a recovery with the virus contained. Here in the U.S., clearly, we're seeing a lot of increases in COVID cases in 40-plus states. So we're going to continue to see a challenging economic environment, and that's going to drive more business relief, and it's also going to drive more support needed from the advisors to their business clients. I'm not going to get into that in greater detail, but that's a slide that we've been using in other presentations. I just wanted to share it. Once again, it's all about teaming and working with the broader stakeholders. Over the past week, just today, matter of fact, we've been speaking with government officials, the firms, the payroll processors, and the lenders, getting an understanding on what they're doing. We did have a recent call with Treasury, and yes, the FAQs are delayed, and it's just there's a lot going on there, and they've just got some competing demands, and they're going to get out that final guidance shortly. We've also been discussing with the lenders and the payroll providers some of the forgiveness capabilities that they're building, and we're really advancing an automated forgiveness tool that's going to be built on top of the AICPA forgiveness calculator, and we'll talk a little bit more about that later. So let's look at the latest SBA PPP numbers. The interesting thing here is, guess what? The total loan amount went down. I don't have it memorized what it was last week, but it was higher than $517 billion. And the reason why is just because there's all kinds of data that's come into the SBA, and as they're sorting through this data, they're seeing some double counting. So that's why the total loan amount is slightly smaller. The number of new loans occurring has decreased. The total number is 4.9 million, and the average loan size is staying pretty flat now. and the August 8th extension. We've talked about that over the past couple of weeks. So let's just talk about what is going on with the policymakers. We're going to have a couple of media articles that highlight this in a minute, but it really is all about PPP2, Phase 2 discussions and the Phase 4 business relief discussions. And those two items, there's beginning to appear that there's bipartisan support for something to occur by the end of July. So a broad business relief bill, which would include things such as, liability protection around going back to work and COVID, would also factor in some additional business relief and potentially wrap in a PPP Phase 2 program. Mark, I don't know if there's anything you want to add about the deductibility.
Yeah, and just to play off of that on this new bill, there's a lot of rumors in D.C. as well, Eric, about whether or not there's going to be this kind of automated forgiveness for smaller loans. That'll be a negotiating chip and all this. There's going to be so many negotiations. Again, as we've reminded our town hall folks over all these weeks, you just got to be careful on the media coverage and what you're seeing and reading, because not everything is going to be final fact in what the final bill looks like. So there will be rumors and hearsay, discussions that are happening in the hallways in D.C., that doesn't necessarily mean it's going to happen. So if they say, for example, that all of a sudden they're going to have automated forgiveness under 50,000, 150,000, whatever that number is, until legislation actually gets passed and signed by the president, we're not there yet. And that's, also leads to the deductibility question as well. And I know we already had a number of attendees already asked this question, where do we stand on it? We haven't changed much in D.C. on this topic. There is bipartisan support for the amounts that are forgiven through the PPP loan to also be deductible on the business tax returns. There is definitely both sides of the aisle who want that. But then again, there's a smaller contingent, but there's still a contingent out there, bipartisan, who believe that they shouldn't be deducted. Now, we hope that those who are saying that it should be deductible will outweigh the others. But as I mentioned, with all of these things on Phase 2, additional business relief, do they make changes to PPP forgiveness? These are all going to be bargaining chips, and that legislation around deductibility has a chance to be kind of swept up into that conversation. We would hope that something happens by July as part of this bigger package, but it's still kind of up in the air with everything else. Eric?
Thanks, Mark. So, as we just said, the big topics are, the additional relief, but also the business shutdowns. The continuing shutdowns, and that is definitely making the policymakers think through what is needed. One thing about PPP2 is that there will be more criteria. Here's another article about some big businesses that got loans meant for small businesses. So you can almost take that as a certainty that after August, if you have any clients that want to apply that haven't applied, it's going to be a much broader eligibility with the current PPP program. We do know, though, what PPP2 is all about is a second loan for a business that's still experiencing a lot of distress, and that's what that next program will be about. And there will be more criteria, such as revenue declines and things like that you'll have to meet to become eligible. So let's kind of move into talking a little bit about some of the latest guidance, Mark. I already stated that, we have been, you and I, and mainly you and I, Lisa has been covering the guidance, but you and I have been talking about how additional FAQs are coming, and we almost got an apology from some of the government officials saying, yes, we thought it was coming, and it is in process, and these final elements will be out. One other thing that we did learn is that they're going to wait to see what happens with this broader bill before they probably issue a new forgiveness form related to the extension. But Mark, anything else you want to add, and then I'll let you go into these next couple of slides.
Yeah, so that's exactly right, Eric. I mean, that's the issue is, and we realize that you are getting anxious clients who are asking probably on a daily basis if we're ready to start calculating the forgiveness. The fact is that we still have so many unanswered. Lisa Simpson put out a fantastic blog post the other day. It came out on the 14th. It's on our website. I think the link is included somewhere here in the materials. We'll talk about it in a minute. But that blog post was basically about the patients, and that's kind of where Treasury and SBA are at right now too. Because of all these conversations on the Hill, does it make sense to reissue another application now revised and additional FAQs, only to see them change again, quite possibly based on what's going to happen at the end of July? And with all this said, are the banks even ready to start accepting applications, and is the SBA? So there's just a lot of factors to that to say that many just aren't ready. And so, there aren't any real deadlines that we're up against on this. So it's not like we're saying that, it's now January 15th and, Treasury and the IRS haven't come out with guidance on new tax legislation, and therefore the forms can't be updated in ProSystem and the like, because we're not at that deadline yet, or even in that window. So, August 8th, Eric mentioned the extension to August 8th. That will make some minor changes to the application, so they already know they have to change it. But they do not want to do that yet until more of the recent discussion gets flushed out. So when we look at the landscape, yes, we still need some guidance from SBA. They're working on it. Eric mentioned that. Most of the lenders aren't accepting applications yet. In fact, Lisa had a conversation with a group of lenders today who have also been talking to the SBA. Now, there's three stakeholders here, and Eric, back on slide 10, really laid out all the stakeholders in this process very well. But they're all part of this ecosystem. So your clients, the businesses, and maybe even yourself, waiting to submit loan applications. Then you have the lenders who aren't ready to accept it yet because they haven't built their back office system, nor have they received either guidance from the SBA or a tool from the SBA to be able to upload the forgiven applications. The loan application and the forgiveness application system, the E-Trans system, they will be different. And therefore, the lenders don't even have access to a system to be able to even post these up, even if the bank felt that their system was ready on the back end. So the SBA has got to get the back office tool done, and the lenders need to get the guidance from the SBA, and part of that back office tool. There's just so much to it right now that no one is ready to administer the forgiveness. The payroll providers are also developing reports that are providing some great guidance that is going to be part of this bigger ecosystem. And then Eric's going to talk about a great tool that we've been working on and getting a lot of great information to help you and to help your clients with actually doing the forgiveness process. So, we still have time. The blog post is out there. Send that blog post to your clients. I think Lisa told me today, as of this morning, it's had 35,000 views in 2 days. That is record-breaking. I think it has everything to do with the author and how dynamic the blog post is. So do take a read on that and send that to your clients. If we go to the next slide, Lisa mentioned already, we've done the forgiveness application. We've done the forgiveness tool. The tool is going to be built into a more electronic version that Eric will talk about and Lisa will talk about in a little bit. And so there really hasn't been anything that's changed inside of this tool as we move forward. But the important thing, as Lisa mentioned before, we've already gone through this in detail in a number of weeks. We have the backup slides as part of the downloadable materials. You can go back and take a listen to it. The materials are there, so we're not going to spend a lot of time today on the forgiveness calculator. But this new tool, expect something, hearing something from us next week. You'll get a little preview as to what we talked about today. But do expect to hear something about this in the next week. And we do think that this is going to really help the process become more efficient along the way. Eric?
Yeah, thanks, Mark. So I'll just have a couple of quick comments, then we'll get into the discussion with Ron. But this will be launched next week. We will email information out to all past town hall attendees about this. It's going to be just like the AICPA calculator. It'll be a free tool, but this will be an integrated tool that we're doing with a fintech partner, and it will allow you to enter all of the data required for the forgiveness process. It will also allow you to upload source documents, and there'll be a CPA client module so you can manage multiple clients, and then obviously your client will be doing the signature of the 3508 or the 3508 EZ, and it will facilitate that process. So as we've said, now we have time. We've had time to build tools for the forgiveness process. When I look back at April 3rd or April 10th that week, there was no time to put together a tool. All we could do was just work on explaining the process to the firms, and then the firms working with their clients in the bank process. So we've had more time, and there's going to be more sophistication and many things for you to leverage. So that announcement will come out next week. So with that, I've been looking forward to this. Let's kick off the discussion with Ron. We've got some questions here, but this is going to be free flowing. Mark will join in with me. I always learn a lot in these discussions with you, Ron. So let's just kick it off at a very high level. You and I have talked about what this current moment means for firms, and how exciting it is on how relevant they are. But why don't you kind of provide your perspective here?
Yeah, I think that's one of the main things, Eric, is that the relevancy has been restored as part of this crisis. And it's just really illustrated that the work that we do as CPAs is not a commodity. I hope if one word gets purged from firms' vocabulary, it's the idea that whatever they do, I don't care if it's an audit or a tax return, is a commodity. There's no such thing as a commodity. Customers are buying our intellectual capital that can result in peace of mind and convenience and the feeling that they're being taken care of. And the other thing I think that this COVID crisis has proved, along with other crises from the past, is that this is a relationship-based profession. It's not a technology-based profession. Technology is a tool. This is all about relationships, and I think that our business model has to reflect that relationship and put it at the center of the firm.
When you think about that, Ryan, you think about what has occurred here with some of the pressures that firms thought about over the last couple of months on just what do I've got an issue with my lender, how should I bill for this, you bill the client, what's your comments there on just some of those shorter term issues?
Right. Well, obviously, if they're hourly billing, I think that's pretty suboptimal. I would hope that at the least that they'd be giving their customers a fixed price for this work in advance. I think the firms that are value pricing, and there's a good number of them out there, have just basically handled this additional work by issuing change requests and change orders, or building it into their fixed price agreements. And I've also seen a lot of firms come up with pretty innovative subscription models to cover all of this loan forgiveness and PPP Act in very innovative ways. So basically putting their customers on a monthly plan for as long as it takes to get them through this period.
Ron, just
That's
on
interesting,
that,
Ron, on the...
Go ahead, Mark. Go ahead. Sorry.
Yeah, sorry. Ron, you and I have talked a lot about the subscription model. So on that monthly subscription that they're putting together, is there a specific time frame, or are they just going to start doing this on a monthly basis, and are they included their regular work outside of the subscription-based price for just the PPP-related stuff?
Yeah, a lot of the firms, Mark, that did this actually put it out and made it available for just new customers that weren't customers of the firm for tax or other services, and also made it available as an add-on to their existing customers. And what we're seeing is it's driven a lot of new customers into the firm. It is a monthly subscription, and one of the goals with that business model is you make it very, very easy for the customer to get out of it. So at any time they can cancel, but you also make it very easy to stay in it. And the goal with this, of course, is to make sure that you see them through the forgiveness process and any other things that are going to be a follow-on as a result of all of this.
So right now, Ron, I mean, many of the attendees here, I don't think have moved to subscription pricing. I mean, you're talking about some firms that we've had discussions with that really had that model in place, and it really served them well. So they've potentially, some of these firms who had run into issues with some of the confusion around agent fees, but now that's all behind us. Now they're moving forward with the forgiveness process. How do they go about that? How do they go about in a time of crisis shifting a business model or a pricing strategy?
Yeah, and I think this is a great time to do it, because even though we're in the flurry of all this work, to some extent, the plane's on the ground, and it's a little bit easier to change this when it's on the ground rather than when you're flying. And one of the things they can do is they can test this model. They can just make it available to maybe certain customers, maybe their best customers. Maybe they can make something available that would draw in new customers. The goal here, it's kind of like concierge medicine. I think our business model, because we're relationship-based and so relationship-based, we need to build in that peace of mind and that convenience and give the customer the feeling that no matter what type of exogenous shock hits the economy, whether it's another pandemic or a recession or whatever, they've got peace of mind that their firm is going to take care of them. So we move away from this transactional basis of selling services. I don't want to sell services anymore. I want customers to subscribe to my firm. And I think that's an enormous psychological change. We subscribe to a lot of things, whether it's Disney Plus or Netflix or even Amazon, and we feel like we have a relationship with those companies because they know so much about us. And I think it's the same thing for CPA firms. We need to put that relationship front and center, and we need to stop thinking about scope and out-of-scope work and start thinking about covered and non-covered services. Because if you're with a concierge doctor, they're responsible not just to get you well when you're sick. They're responsible to keep you healthy. And we're kind of doing the same thing for our customers on the financial side. And that's much easier to do in a subscription model, so you don't have to worry about, I did more work for this customer this month and therefore we need to bill them more. No. You're looking at this from a portfolio basis and a relationship and a lifetime value basis, and that's a far more powerful model.
Well, so good advice. So start with a couple of new clients. Don't do a full switch over. One thing that we are seeing also is the client accounting services model, and then that is turning into not just a growth area, but a must-have for firms in this new environment, and that has been a subscription service. So client accounting services is somewhat there. And your concierge model, that advice makes a lot of sense. So let's talk a little bit about how you've seen, this new remote work environment, and you've talked to me about results-based performance.
Yeah, I'm a big fan of what's known as ROE, the results-only work environment, because the other thing that this crisis has taught us is that we can work remotely. Even the firms that said they couldn't do it, like you keep saying, Eric, they figured out how to do it within 48 hours or less. And, work is something you do. It's not a place you go. And nowhere is that more true than in knowledge work. I mean, J.K. Rowling wrote a whole book, sitting in a coffee shop in Edinburgh. I mean, it's the ultimate knowledge work. We're not tied to a factory. We're no longer tied to a phone line. We can work anywhere. And our management structures and institutions need to reflect that. And yet all of our management theories and practices were built for an industrial era. They come out of the 1880s and possibly go up into the 1950s. Well, Rowe, results-only work environment, is one of the few management innovations that have hit in the last 50 years that I think is absolutely transformative because, it manages the work, not the people. And that's a big deal. When you look at a pile of laundry, you don't sit there and go, I really need to put in the hours. No, you're trying to figure out how to get it done quicker so you can go do something else even more valuable or pleasurable. Well, it's the same thing at work. But at work, because of our measurements and our KPIs that we use, we measure inputs because they're easy, like number of hours or presenteeism. Are they the first one in, last one out? But that doesn't have anything to do with results. Even CPE measures the inputs rather than the learning, and that doesn't make any sense. So in a knowledge environment, the results-only work environment, just like its name says, it focuses on results to the customer, and that's what we should be thinking about, and that requires judgment. And in a knowledge environment, a judgment trumps a measurement.
Great.
Judgment trumps a measurement, yeah.
We should have noted a results-oriented environment, Rowe. So I actually was with a software company the other day, and their CEO told me they polled, they're all remote now, and they polled their employees, it was decent size, and if they wanted to come back into the office, and 98% said no. That's pretty dramatic. What do you, when you're advising and working with a lot of firms, where do you think the firms are with this, with how they're going to operate in the future?
Yeah, I think firms are going to have to adapt to this because I think it's going to be driven by the talent. If these younger generation and the upcoming students coming out, if they know they can work remotely, then that's going to be where they go and want to work for firms that offer that possibility. They don't want to be hamstrung. That's not to say that physical gathering and getting together with your colleagues isn't important. Of course it is. I mean, we do have to bounce ideas off one another, and there's a lot to be said for serendipity and, those hallway conversations or whatever. But this is going to be something I think that's going to be driven by the competition for talent. And if firms try and do things the old way, whether that's hourly billing or your butt has to sit in the cubicle for 10 hours a day during busy season, I just don't think that's going to fly with the knowledge workers of the future.
What do you see are the biggest issues facing firms right now? We got some, we got some questions coming in. And I'll just one on the covered services. And you need to define everything you're doing in an engagement letter so that there's how do you manage risk there? But anyway, I throw you a question from the audience, and I'm also throwing you a question. Just what are the biggest issues that firms are dealing with right now?
Yeah, I mean, other than, the normal things that everybody always talks about, the talent and all of that, I still think it's our obsolete business model. And, hourly billing is dead, and the firms that are still doing it just don't realize that yet. But even fixed pricing is not enough. And I hate to say this, but even value pricing, which I've been advocating and writing about for 2 decades and a half, pays lip service to innovation and the relationship. The subscription model puts these things at the heart of the business model. It breaks down silos. There's no room for silos in a relation-based, subscription-based, because you do whatever you need to do for the customer. In terms of the engagement letter, covered, non-covered services, yes, you have to be specific. But when something pops up and it's covered, just do a separate engagement letter for it. But there's not going to be any price because that's part of their subscription price. So that's how I would answer that question.
Thanks, Mark.
Thanks. No, I have no other questions for Ron. I mean, I'm just, as I'm looking through the questions here, I guess the only other thing that came up, and I just want to address it kind of live, is folks are asking, how do you bill for the PPP-related services up front on the application when the application says that you can't bill the client for it? And Ron, you and I have had a lot of discussion around this. So just the whole idea of advisory services, or even in that client relationship throughout the entire year. Maybe, you know, a lot of what we've said in prior sessions in town halls was the fact that, you know, before you could even fill out the PPP application, you have to figure out if the PPP loan was even the right vehicle for the client.
Right.
So talk a little bit about advisory services and this pricing, or even, you know, God forbid that we can't bill the client for it, quote unquote, but what it does to the relationship if we don't, and what ends up happening there.
Right. And look, I would say that you just don't worry about it. Take your clients through this situation. Get them through this, because it's going to pay enormous benefits in the long run. Forget the math of the moment and look at the lifetime value. But you got to disengage the idea that you're being paid to fill out a form. You're being paid for your intellectual capital and the access to you and advising under different scenarios and what's best for the customer. It's like getting a second or third opinion from different doctors. That's what they're paying you for. They're paying you for your judgment, and that can be wrapped up into an advance price for a period of time. Maybe you give them 6 months, a year coverage, whatever, or you do one of these subscription services like some of these firms have done. In fact, this one firm I'm looking at, they've offered 3 options for COVID and PPP type support, forgiveness support, and all of that. The middle option, they team up with a lawyer to help you with legal questions that might be surfaced because of all of this. And then the third one, they team up with other type of family office solutions like financial planning, or, you know, would you have to redo your will, or any type of estate plan. So there's all sorts of innovative ways that you can not tie your pay to the filling out of forms or the delivery of a service. It's to your access and your advice and your counsel to take the client through these situations.
Ron, great perspective. And one thing that we started off today talking about how this is a defining time, and you started off the discussion here on the importance of relevancy. So if you had to think about 2020 and the amount of change, we've had so much change so far, and the firms have stood up and helped, you know, drive the 5 million loans that have been given through the PPP program, and have really helped the U.S. economic environment. And now there's going to be more change occurring and more increased relevancy. And we're talking about how you have to work with the changing business models for your clients. So take advantage of this to evolve your business model for your firm. Listen to some of this advice from Ron. I can tell you firms who have listened to Ron have really found greater success. It's not easy. Change is not easy. We will, in future town halls, have a panel discussion with some firms that have evolved some of the business model. We had a discussion with Dixie McCurley a few weeks back on how she did have some of these subscription pricing models in place. So it's an opportunity now for you to make this change. So Ron, give you just a final comment on anything you want to share with the audience before we move into a technical topic, the ERC topic.
Okay, well, thanks, Eric. As I just want to make one point, there's a great duality to this subscription idea. Not only do I think it's the future for professional firms, it also applies to your customers, because one of the things that we're seeing from the empirical evidence that's coming in is businesses that are under a subscription model have been the most resilient throughout this entire crisis. Zora, which is a subscription software company, has a think tank that looks at this, and they have sample surveys that they do. But the bottom line is 53% of companies that have a subscription model have not seen an impact to subscriber acquisition rates. In other words, they're growing at the same clip they've been growing. 22% of them are growing at an accelerated rate. and about 13% of them are slowing growth, but they're still growing, and only about 11% is where the churn is increasing over the acquisition rate of new subscribers. So it's an incredibly resilient business model for all different types of businesses. I mean, just think about how many of us said, oh, I want to save, during this COVID crisis, I want to help save my local favorite Thai food or pizza joint or whatever. Imagine if you could have subscribed to them. That would be the way to do it rather than, prepaying gift cards or whatever. Subscription is incredibly resilient, and that's borne out by the empirical evidence that is pouring in from the last quarter or so.
Oh, great final point for us. And Netflix is releasing their earnings today, and I think they're probably going to be doing okay.
And Zoom, yeah.
And Zoom. Ron, we'll be coming back to you for the open forum, but thanks for that perspective.
You bet. Chris, thank you, Eric.
Hey, thanks. Let's move into doing a little bit of a deeper dive into an employee retention credit. What this is turning out to be is a multi-billion-dollar credit for companies that aren't taking advantage of PPP. So this is very, very important. So Chris, with that, I'll turn it over to you.
Thanks, Eric. First, we're going to start with a few basics. The credit was enacted as part of the CARES Act, and it's actually a way to provide some liquidity for those folks that don't get the PPP loans if they're not qualified for that, and if they keep their employees on the payroll during the pandemic. There's no limit to the number of employees that a company can have to take this credit, like some of the other COVID-19 related benefits that are targeted mainly to small businesses. This one is kind of open to everyone. And on face value, the credit, it seems straightforward. Basically, if an employer is engaged in a trade or business and it meets a couple of tests, it can take up to a $5,000 per employee credit against their Social Security taxes. And I want to quickly go through the two tests that I'm speaking of. You look at the wages that an employer pays in a calendar quarter in which the business operations are fully or partially suspended due to a government order, or if the business has a greater than 50% decline in gross receipts in a calendar quarter as compared to that same quarter in 2019. So all of that on face value, not too difficult. But the devil is always in the details with tax. And like many other tax credits, there are a lot of details. There are currently almost 100 FAQs on the IRS website, and they're there to help tax practitioners and businesses to navigate the mechanics of this tax credit. And we actually could do with a few more. So if that's not an indication of how convoluted this credit can get, I'm not sure what is, because 100 FAQs, that's a lot on a tax credit. Next slide. The good news, though, is that the IRS does have all of these FAQs on their website, because these FAQs are the holy grail of info on the employee retention credit. And I've heard a lot of our members say to me, Chris, we can't rely on FAQs. They're not legal authority. Technically, yes, that's true. They're not legal authority. The IRS website even says that FAQs can't be relied on as legal authority. But we are not going to get a notice on this credit. We're not going to get proposed regulations on this credit. So we need to get comfortable with the information in these FAQs, because that is the information that we have to work with, and that's the information that you need to know to help your client. In these FAQs, they run the gamut from how to determine if a business is eligible for the credit, meaning do they pass one of the tests, how to determine which employees to include in the calculation, or to determine which wages to include, and how to calculate the credit. I mean, they cover almost everything. Almost, I say, because there are a few areas that could still use some guidance. But one thing that you have to watch out for is when the IRS updates these FAQs, they don't normally just add a new one at the end of the list. They're going to add FAQs throughout, or they'll even revise a previous FAQ and just note above it the date that it was revised. And there aren't any bells or whistles that are going to go off to announce that, hey, the IRS updated an FAQ. So that means, unfortunately, that you have to constantly look at these FAQs especially if there's an area that you think might change. And one of the areas is on the test of whether or not a business has a full or partial suspension. Now, I want us to walk through a few of the FAQs that have changed or been added in the past month, in the past several weeks. FAQ 28, that one relates to governmental orders, and it's important to know what constitutes a governmental order to determine if an employer has a full or partial suspension of their business. And the addition to this FAQ was one small bullet point, but it's an important one. It says that an order from a local health department mandating a workplace closure for cleaning or disinfecting is considered a valid governmental order for purposes of this credit, because you always need to look back to the governmental order if you're looking to see if you qualify for this credit. Now, FAQs 30, 33, 34, and 35, they all relate to determining if an employer has a full or partial suspension of operations. And like I said, this is an area of the credit that's convoluted and it still needs some work. So keep checking this area. Number 30 was updated to clarify that an employer operating an essential business can have a partial suspension of its operations if greater than a nominal part of its business was suspended by a government order. Now, what's a nominal part? Well, that's a good question. But if a business if a business continues their operations but closes for a period of time during their normal work hours due to a government order, that is considered a partial suspension of its operations. And these clarifications were actually very helpful because more businesses, it allows more businesses to qualify for the credit. The way the original FAQ read was that if a government order allows an essential business to remain open and continue its operations, then it wasn't deemed to have a full or partial shutdown, which that makes sense, but in reality, there are these other situations that they've just addressed where the fact patterns, they just didn't fit neat and clean. They weren't so straightforward. So we kind of, we were happy to see these. They were welcome clarifications and a welcome expansion of some circumstances to be able to take the credit. On number 33, the original FAQ, it actually said that if an employer was closed by a government order, its operations continued because its employees were able to telework. There would be no full or partial suspension of its operations due to a government order. Again, that makes sense. The updated FAQ, though, it adds that if there's a closure of and it causes the employer to suspend their business operations for certain purposes but not others, it may be considered to have a partial suspension of its operations. Now, that language, for certain purposes but not others, a little tricky, clear as mud, but luckily they did provide a couple of examples to walk through that. You can go to the next slide, please. 34 and 35. These were, a bunch of examples were added to these to provide some additional clarity, again, in order to how to determine if employer has a full or partial suspension of their business. And this is an area, I work in our tax policy and advocacy team in Washington, D.C., and we are still writing letters to the IRS and Treasury. We have one in process now on these issues related to full and partial suspensions, because there are still some areas that are not clear. So these examples, when they add these examples to the FAQs, it's very helpful. Now I'm going to turn to item FAQ 46, and it's on a different topic. It's actually on the other test, the gross receipts test. And we really needed this one. It actually tells us what to include in gross receipts for a tax-exempt organization if they want to know if they have greater than 50% decline in gross receipts. Now, we already knew what to include in gross receipts for a for-profit entity, but originally the IRS punted on nonprofits. But finally, on July 19th, they actually updated the FAQ and gave us the information. So what does a tax-exempt org actually include in their gross receipts for tax purposes or for purposes of the employee retention credit, and only the employee retention credit? So They said gross receipts from all operations and not just gross receipts from activities that constitute unrelated trades or businesses, which that's a tax-exempt term. That means you include gross receipts from sales and services, even if those amounts aren't related to the organization's tax-exempt purpose. And it also, you include your dividends, rents, royalties, contributions, any gifts, grants, or member dues. So you kind of put that all into one bucket, and if you're looking at that at one quarter in 2020, you look back to 2019, that same quarter, and that's how you determine if the tax-exempt org has greater than 50% decline in gross receipts. And like I said, very happy to have that information because it took some time for them to get that out.
Hey, Chris, we're getting lots of and we'll hit these, I know, and we're going to talk about a webcast coming up. We're getting questions just about if you took the PPP loan and you've exhausted funds and now you need more funds, is ERC an option? So maybe just a broad comment. I think we stated that at the beginning, but let you cover that again.
Right. No, it's not an option, but we are actually looking. There are a lot of acquisitions going on related to the economic havoc caused by COVID-19, and we're actually trying to write a letter right now that, you know, if a company took a PPP loan and they acquired a company that maybe that didn't qualify for that, and so they took the employee retention credit, you know, if there was a acquisition or a merger per se, then we're saying, you know, you shouldn't have to give that employee retention credit back for the company that was purchased, because right now, sometimes the only time a company can stay afloat is if somebody else acquires it. So we're working on at least getting some relief in that area.
Okay, that's a good one. Good one for us to follow up on in future sessions.
Absolutely.
And you're going to why don't you cover a little bit here, Chris, you're going to be going deeper dive into some of this later on this month.
Yes, we are. So I'm going to invite you to continue this conversation with us. You can join us on our webcast. It's titled Mastering the Employee Retention Credit. And we're going to take a deep dive into the ins and outs of the credit, and we're going to walk you through real-world examples because I love teaching through examples. Folks can really see the mechanics of how things work. So we're going to look at these FAQs, and we're going to put them in example format for you and walk you through that. And it's on July 29th, and you can register at the link that's shown on the slide. Thank you very much.
Yeah, thanks. Fantastic, Chris. And let's just step back a little bit. Mark was mentioning this earlier. So thank you very much for that overview on ERC, and maybe we'll take a couple of questions during open forum related to it. But there are many different relief options available. One thing on that ERC, you know, for clients that you have that did not take the PPP loan and are under 100 employees, and if you qualify, then it qualifies for all 100 employees. So there's some, you know, real opportunities there that are material for businesses under 100 employees. It could be a few $100,000. You do the math. And then for large companies, these numbers can get quite large and get into the millions of dollars as tax credit. But when you look at all the different options, it's important to you know, look at which one is the right one for your client. And in this final category here, additional relief programs, we're going to have more coming out at the end of July, most likely, and we'll be sorting through that as well. Not much more to report on Main Street lending. You know, both the borrowers and lenders, there's not a lot, the interest isn't high. Mark, Lisa, anything else you want to add on these before we move on?
No, I think, as you stated, I mean, the ERC, if you have a client that wanted to keep their name out of the paper, hopefully you're talking to them about the ERC. So if they declined the PPP or gave it back, so officially aren't a PPP lender or borrower at that point, ERC might be a really great option, and you better tune in to Chris at the end of July.
Okay, so Lisa, you've been looking at the questions. Let's bring a couple of questions to the panel.
Let me ask Chris one more question that I think is a really good one. Can a Form 941 be amended for the second quarter if a business later learns that it qualifies for this ERC but didn't take it?
That's a good question, and I'm not sure if they amend it for a quarter or you need to just take it in the next quarter.
Got it. So tune in to the deeper dive, and yeah, it's a great question. So, okay, thank you on that one. We are getting a question about which lenders are still accepting PPP loans. I will throw a few out, and then Mark, Eric, and the audience always crowdsources this answer for us as well. So start putting those into the chat. It's my understanding that Wells Fargo, Biz to Credit, Fundbox, that's Fundbox, are still accepting applications. And Eric and Mark, I'm not sure if you know of any others.
No, all I would add is two things we've heard is one, those companies are taking new applications, and then I know that even Biz to Credit is taking applications, and they have a process. If someone did pay back their funds for whatever reason, and now they feel they have the economic impact and they need the funds and they want to reapply, they're taking reapply applications from those businesses.
We're also hearing that Lendio, Lendio, and Kabbage, Kabbage, are accepting. Divvy, Divvy, Chase, First Horizon Bank. So Lender Match on the SBA website is a great resource to check out, and got a plug for our local community banks because those are also another great resource and a way for you to develop a stronger relationship with the banks in your community. So check those out as well.
Hey, Lisa, here's a question for Ron. I mean, how has Ron seen profitability of firms work out with the subscription-based model pricing? Do they set a cap on the number of hours work provided in a given month before charging additional fees?
No, there's no cap, because if the work is covered, then you do whatever it is that the customer needs. That's the whole peace of mind and convenience component of this, kind of like an insurance component. But let me just say that when you move to this model, you're probably looking at a 3 to 5, maybe even more times price increase for each customer. I mean, just like the model is concierge medicine. The law is not, the model is not like a law firm retainer, as somebody asked. That's not the model. The model is a concierge doctor. You pay $20,000 a year, and whatever you need medically that doctor is capable of doing is covered, that he's capable of doing under his roof. Now, if he has to refer you out to a specialist, just like if we have to refer somebody out, that's going to be extra. But that's got to be built into the business model, and that's why the pricing is so important, and the value, and the marketing, and the branding, and the positioning.
Right, Lisa. I don't know if there's one more question. I love in the chat here we're getting, Chase is still taking them, B of A to end of the month, and that's great. It's great to see the national banks have got their windows back open. Any other questions? One last question for the group, Lisa.
Let's see. I think it is important to note that a lot of the banks are setting earlier deadlines for this round of applications. So if you are interested, or if you have a client that's interested, definitely go ahead and get moving on it rather than waiting.
Lisa, I actually have an answer for you. I was looking it up while you asked me a question about the 941 being amended later if a business learns it qualifies for the ERC, and I didn't know the answer. I just looked it up, and it seems that you don't amend it, but you actually put it in a later quarter, which makes sense.
Thank you so much.
Well,
you're welcome.
Well, excellent, Lisa. And Chris, on that, I'm going to move on. All I will say is we are using social media to kind of give announcements out between the town halls. You see my social media, Mark's, Ron's, and Lisa's. Feel free to leverage those, and no one's hacked our social media accounts. So let's continue on. Here is the resource page that Lisa and her team have worked tirelessly on. It's the most visited page on the AICPA website, has all the calculators, the FAQs, and much more guidance information. We also have a broader tax resource center. Chris Esposito and others are supporting this, so another good tool for you. Here's some of the other upcoming learning opportunities. The one on the ERC is going to occur at the end of the month on July 29th. And then just finally, to wrap up here, we are going to have a town hall next week, but next week is the AICPA Engage virtual conference. So we did not want to conflict with that. So we're going to move up our time to 10 a.m. So we apologize for the folks on the West Coast. Have breakfast with us at 7 a.m. So it will be next Thursday, 10 a.m. We should have the FAQs by then. And we really do value being with you every week. We learn a lot through these questions. We tabulate these questions. They help drive our resources. I want to thank Ron Baker for his insights today. So thanks for being with us. And also thank the AICPA leadership group here, Mark Cozio, Lisa Simpson, and Chris Esposito, and the broader team that puts on this event. So we hope you all have a good week. Thanks for your time, and we'll be in touch. That's all for now.